The last mortgage statement arrived in a plain white envelope on a Tuesday afternoon, and it sat unopened on the kitchen counter next to the grocery list. Dinner still had to be made. A load of laundry was in the dryer. The dog needed to go out. The envelope was just another piece of mail. Until later that night, when the house was finally quiet and the overhead light above the stove was the only thing still on. Inside was a short letter confirming that the balance had been paid in full. For 26 years, the mortgage had been a fixed presence. It began when the house felt larger than necessary and the children were still sharing a room. The payment was manageable but tight. Back then, every extra dollar sent to the bank felt like a statement about responsibility. An additional $200 with each check, sometimes $300. Tax refunds went straight to principal. Bonuses, when they came, did not stay long. There was satisfaction in watching the balance fall faster than the original schedule allowed. It felt disciplined. It felt adult. It felt stable. The house itself changed slowly around those payments. A fence was added. The kitchen was updated once. Carpet was replaced with hardwood after the dog chewed through the corner of the living room rug. Through all of it, the mortgage payment was the constant. It shaped vacations, the timing of car replacements, even the choice to skip a larger SUV when the third child was born. Paying extra on the mortgage was never dramatic. It was repetitive, quiet, automatic. There was pride in it. Friends refinanced repeatedly when rates dropped. Some took cash out to remodel or consolidate debt. That never felt necessary. The loan stayed simple, fixed rate, predictable. Each year, the principal portion of the payment grew and the interest shrank. The amortization schedule was printed once and folded into a file folder in the home office. By the time the children were in high school, the mortgage balance was already less than half of what it had been. College tuition bills were arriving then, thick envelopes with itemized charges and payment deadlines. There were conversations at the dining table about savings accounts, scholarships, what could be covered, and what would require loans. The extra mortgage payments continued. There was something reassuring about eliminating debt in one area of life while it was increasing in another. When the first child graduated from college with student loans, the mortgage balance was down to 5 figures. It felt like progress, even if the household cash flow had tightened again. The day the final payment cleared, there was no ceremony, no sign in the yard, no public announcement. Just a letter confirming what had already been calculated on the online account weeks earlier. The house was owned outright. In the months that followed, the monthly budget shifted. The mortgage payment line item disappeared. Property taxes and insurance remained, but they were smaller. The checking account balance at the end of each month began to look different. There was more room. At first, that space felt like relief. There was the sense that something heavy had been carried for decades and finally set down. Work felt optional in a way it had not before, even though retirement was still several years away. The house was secure. No bank could claim it. That mattered. But the shift in cash flow brought other details into clearer view. The retirement accounts, while steady, were not large. Contributions had been consistent but never aggressive. Extra income had gone to the mortgage instead. Investment statements arrived quarterly, their balances respectable but not expensive. Co-workers around the same age spoke casually about their brokerage accounts, about market gains over long stretches of time. There were conversations in the break room about compounded returns and how early investments had grown almost on their own. Those conversations felt distant at first. The mortgage was gone. That was tangible. It could be touched. It was visible in the absence of a bill. Yet over time, the numbers on the retirement statements seemed to carry a different weight. The house, fully paid, did not produce income. It did not send a dividend. It did not grow quietly in the background. Its value rose and fell with the local housing market, but that appreciation was theoretical unless the house was sold. And selling was not part of the plan. The house was stability, it was not liquidity. Work continued. Promotions came slowly, and salary increases were steady but modest. Health insurance premiums rose year after year. The children moved out, one by one, but expenses did not shrink as much as expected. Utilities stayed high. Property taxes climbed with each reassessment. Maintenance costs surfaced in uneven waves. A new roof was needed 5 years after the mortgage was paid off. The cost was substantial. It was written as a single check from savings, which had grown partly because there was no longer a mortgage payment. There was a quiet realization then that the absence of a loan did not mean the absence of large expenses. The house aged along with its owners. Friends who had kept their mortgages longer or who had refinanced into lower rates and invested the difference spoke about account balances that had crossed certain thresholds. Some retired earlier than expected. Others reduced their work hours. There was no clear comparison, but the contrast lingered. Equity in a house does not pay monthly bills unless it is converted into something else. There were options available in theory, but none felt natural. The house held memories. The bedrooms still had faint outlines where posters once hung. The backyard tree had grown tall enough to shade most of the lawn. Leaving did not feel like a financial decision. It felt like something larger. So the equity remained embedded in the walls. In the early years of ownership, sending extra money to the mortgage felt like control. Interest savings were calculated carefully. There was comfort in knowing that less would be paid to the bank over time. The math was clear. Interest avoided was money kept. What was less visible at the time was the alternative path that money might have taken. Monthly contributions to retirement accounts were set at levels that felt manageable. Enough to capture employer matching, not much beyond that. The logic was simple: eliminate debt first, then invest more heavily. Decades later, the debt was gone. The window for decades of compound growth had narrowed. This was not a dramatic loss. There was no financial crisis. Bills were paid. The house was secure. Retirement would still happen, just perhaps with more caution. But there was a subtle recalibration of expectations. Instead of imagining extended travel or long stays in other states to visit family, there were more modest plans. Week-long trips rather than months. Careful budgeting for healthcare costs that loomed larger with each passing year. The mortgage payoff had been a milestone. It marked discipline, endurance, and a kind of moral clarity about debt. Yet, the balance sheet told a more complex story. Net worth looked healthy on paper because the house represented a large percentage of it. But accessible funds were smaller. Investment income would not fully replace a paycheck without careful management. There was an afternoon spent reviewing all tax returns and statements. Numbers from 20 years earlier felt almost abstract. The extra principal payments added up to a significant sum over time. Had those amounts been invested instead, the outcome might have been different. Not necessarily better in every way, just different. Security can take more than one form. For some, it is the absence of any loan attached to their home. For others, it is a portfolio large enough to generate income regardless of employment status. In this household, security had been defined primarily by eliminating debt. That definition had shaped financial decisions for decades. Work in the later years felt heavier than expected. Not unbearable, but more deliberate. The idea of stepping away entirely required careful projections. Healthcare costs in retirement were not small. Insurance premiums and out of pocket expenses added layers of uncertainty. The house, meanwhile, required ongoing attention. The water heater failed one winter. The driveway developed cracks. Landscaping that once felt manageable began to feel like labor. There was pride in owning it outright. No one could question that. But ownership did not reduce responsibility. There were moments of reflection, usually late at night, when the house was quiet again. The absence of a mortgage payment was still noticeable. It made the monthly budget easier to breathe through. Yet, it did not create the kind of financial flexibility that had once been imagined. Some coworkers who had invested aggressively during the same decades now spoke about market volatility with calm detachment. Their accounts had weathered downturns and grown through recoveries. The numbers had multiplied in ways that seemed distant from the steady, predictable decline of a mortgage balance. The mortgage balance had only ever moved in one direction. Investment accounts had moved unpredictably, but over long stretches they had expanded. There was no regret in a dramatic sense. The decision to pay off the mortgage early had aligned with values at the time. It reduced stress. It provided certainty during years when job stability was not always guaranteed. During economic downturns, knowing the house was nearly paid off felt like insulation against wider instability. That feeling had real value. But value is not always measured in the same way across decades. In the early years, the focus was on survival and stability. 3 children, rising expenses, modest income growth. That felt like exposure. Eliminating it felt like closing a vulnerability. In later years, the financial conversation shifted toward income streams, liquidity, and flexibility. The house did not adapt easily to that shift. There was an attempt once to consider downsizing. The idea was practical. A smaller home would require less maintenance. Proceeds from selling could be invested. But the housing market had changed. Prices were higher across the board. Even smaller homes in desirable areas carried price tags that absorbed much of the potential gain. Moving also carried transaction costs, real estate commissions, closing costs, moving expenses. The arithmetic did not feel as clean as expected. So the house remained. Holiday gatherings filled it once a year. Grandchildren visited occasionally. Most days, however, several rooms stayed closed. Heating and cooling those rooms cost money. Insurance premiums increased annually. Property taxes rose as the area developed. Each new assessment ladder arrived with a number slightly higher than the year before. Owning a home free and clear did not freeze its costs. There was a quiet understanding that much of the household's net worth would eventually transfer to the next generation, tied up in the home's value. That was not the original intention, but it became part of the broader picture. The mortgage payoff had been a personal milestone. The long-term financial shape that followed was more nuanced. At work, conversations about retirement timelines became more frequent. Some colleagues set firm dates. Others spoke in approximations. In this household, the timeline remained flexible, partly because investment income alone did not feel sufficient. There was the option to draw on home equity through various mechanisms, but that introduced new layers of complexity. The simplicity of being debt-free felt incompatible with reintroducing any form of loan. So employment continued. There were mornings when the commute felt longer than it once had. Traffic patterns had changed. Energy levels had shifted. Yet, the routine persisted. The mortgage had once dictated the monthly rhythm. Now, healthcare premiums and retirement contributions filled that space. The decision made decades earlier continued to echo quietly. In conversations with younger coworkers, the topic of early mortgage payoff sometimes surfaced. There was admiration in their voices when hearing about a house owned outright before retirement age. It sounded like an achievement, and in many ways, it was. The full picture was harder to express in casual conversation. It included opportunity costs that only became visible years later. It included the trade off between guaranteed interest savings and the uncertain but potentially larger gains of long term investing. It included the emotional comfort of eliminating a debt versus the mathematical reality of capital growth elsewhere. The house stood solidly through all of it. Its walls held birthdays, arguments, late night homework sessions, and quiet Sunday afternoons. Financial decisions are rarely isolated from those memories. They are woven together. Paying off the mortgage early shaped the household's sense of identity. It reinforced an image of prudence and restraint. It provided a clear marker of progress in a life otherwise filled with gradual changes. And yet, as retirement approached more concretely, the shape of financial freedom looked different than it once had in imagination. Freedom was not simply the absence of a mortgage, it was the presence of income that did not require a commute. The house, despite being fully owned, did not provide that on its own. There were spreadsheets reviewed on weekends, not out of panic, but out of careful accounting. Withdrawal rates were tested against projected expenses. Healthcare scenarios were sketched out conservatively. The numbers worked, but tightly. There would be no dramatic lifestyle shift, no extended second chapter of travel or relocation. Stability would continue, just under a different structure. Looking back across the decades, the extra principal payments blended into the larger pattern of adult life. They were consistent with the broader instinct to reduce risk, to avoid leverage, to move steadily toward ownership. That instinct had protected the household from certain vulnerabilities. It had also quietly redirected capital away from other possibilities. Both outcomes existed at the same time. The house remained, paid for and familiar. The mortgage statements no longer arrived. Instead, there were annual property tax notices and insurance renewals. Maintenance reminders appeared seasonally. The absence of one payment did not erase the ongoing cost of living in place. On quiet evenings, when the sun angled through the same windows it had shone through for decades, the house felt settled. So did the people inside it. Financial choices rarely announce their long term effects immediately. They unfold gradually across job changes, tuition payments, medical bills, and shifting priorities. The early mortgage payoff was one of those choices. It looked sensible. It felt responsible. It reduced one kind of risk entirely. And it left behind a financial landscape shaped more by walls and land than by liquid assets or expanding accounts. Work continued a little longer than once imagined. Travel plans were measured carefully. The house stood, steady and fully owned, absorbing light in the late afternoon, while retirement calculations rested open on the dining table. Quietly balanced, but not expensive. The years of extra payments embedded invisibly in the structure itself.